24 seconds away from the opening bell. Equity futures just about positive, up a third of 1% on the S&P as we kick off a new trading week, and I say the same thing every single Monday. Big week ahead. CPI coming up in the midterms. I would say it's a big week ahead on the Nasdaq right now, up a half of 1%, kicking high on the Russell as well. The small caps of 6/10. There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year, unchanged on a 10-year at 415.45. In the FX market, euro dollar had a sneak peek at life again, above parity a little bit early this morning. Right now, back to 99.94 with positive 0.4%. Crude unchanged, 92.53. Still trying to get used to it again in the 90s. 92.55 now, basically unchanged on the session. At the opening bell on the S&P, we're about 20 seconds into this. I'll bring up the scores on my terminal. On the S&P, up a third of 1%. Utilities kind of lagging at the moment. Communication services top of the pile, up about 0.9%. Breaking things down for you, here's Katie Greifeld.
Hey, John, well, let's start with Meta after that Wall Street Journal report over the weekend that the company plans to start cutting thousands of jobs this week. Shares are actually rising, though, and that's what's interesting. Maybe because the company is starting to get serious about cutting costs. This, of course, as it's still burning billions of dollars in the metaverse, but that's another story. Apple, too, we've got some news there. The company said that shipments of its newest premium iPhones will be lower than previously expected. The company said demand is still strong, but it's China lockdowns that affected operations at a supplier's factory. That means longer wait times ahead of this holiday season. Shares only off about 0.5% or so. Outside of tech, well, let's talk about Disney because the stock is rallying ahead of tomorrow's earnings report. Disney expected to widen its streaming lead over Netflix. Shareholders seem excited. Shares are higher. JD.com also in the green. It's one of several Chinese internet ADRs higher this morning. The government there saying that COVID-0 policies are still in place. That theoretically means more time spent online. You can see JD.com shares up over 3%. Back in the physical world, though, you have U.S. natural gas soaring this morning. That's as a winter storm hits the Pacific Northwest. That's boosting lights of Southwestern Energy and EQT, John.
I've got complaints about Disney's Hulu, Katie. Have you seen the price increase from $75.99 to $82.99?
My husband handles that, John.
Does he? That's not your thing. I'm handling that right now. It's a problem. Kelly, thank you. The S&P up 0.4%. I'm not sure I've handled that at all. Taylor Riggs, on to the midterms.
I was going to say, you only like Hulu because the Kardashians are on it, John. But
How did you know? How did you know?
Because I know that you love Kendall Jenner and Kendall Jenner only.
This is true.
Let's get to the midterms. And on a serious note, those opening bell that you talked about. Take a look historically, really interesting calls coming out this morning. On one hand, you Morgan Stanley saying, yes, the traditional sort of correlations hold up in midterms. Equity to December looks pretty good. Evercore ISI, though, coming out and saying, you know what, maybe not so fast. This year could prove to be different regardless. I know that we'll all be keeping our eyes on tomorrow and sort of the performance as we head into the end of the year. Take a look at sort of the probability. Hard to be a betting person, but when we take a look at the MAGA ETF relative to the Democratic ETF, in that terminal chart, you'll see that maybe the Republican ETF rises just a little bit relative to that and then predicted the odds of both a Republican House and a Senate. And that is the blue line as well, elevated but off the highs of the session. So if you're a betting person, that's one way in which you can look at it. I think all in all, John, though, for the market, how we're thinking about this is how is equity performance heading into the end of the year in a mid-year year. And this is it. November actually looks pretty good. It looks really good in a midterm year, much better than either an election year or neither year. So that is the momentum heading into this month.
I was a big fan of revenge bodies with Chloe as well, for the record. No one believes this anyway, so it doesn't matter. Taylor, thank you. On the equity market on the S&P, up a third of 1%. On the Nasdaq, up 0.2 also. Morgan Stanley's Mike Wilson expecting stocks to overcome another challenging week. He wrote the following this morning. The bear market rally was severely tested last week with the Fed's clear message that it's far from done. We think it survives again, with the midterms providing the catalyst for lower bond yields and higher equity prices. I'm pleased to say that Mike joins us right now. Mike, I want to start, if it's okay, of course, with last week's note, not the week over the weekend. When you said the Fed meeting is critical for the rally to continue, pause, or even end completely. Mike, when I watched that Fed meeting, I was kind of kneeling or kind of leaning into the end of that one, maybe it ending. Why can this continue?
Yeah, thanks, John. Good to see you. I mean, look, we got to be flexible here. And what I would say is that the message last week from the Fed was pretty mixed, right? The statement itself was dovish. You know, the market rallied off of that. And then the press conference was a bit more hawkish. And look, this is the ambiguity that we have now, right? People have to interpret these statements and these reactions on their own. It's not going to be that exact anymore. The Fed doesn't exactly know how they're going to end this, and neither does any investor, including ourselves. What we do know is that we're getting closer to the end, and the rate of change probably on the pace of hikes is coming down, and that's our forecast, 50 basis points in December, 25 in the January meeting, and then they pause from there. And that's a quick ending. So that's enough for the bond market to potentially rally at the back end, particularly if we get the outcome in the elections that we expect tomorrow.
Let's get to the midterms in a moment. Do you consider the end of hiking the end of tightening? And it sounds like you do, so let me ask you this. Would you consider a Fed that pauses and stops hiking but a recession that rolls over to be tightening or not?
Well, it's all one and the same, right? So the Fed is likely going to achieve its goal. It already has in terms of slowing the economy. Ultimately, I think they'll be successful in getting inflation down because it's not really about the Fed so much as it is about the excessive fiscal spending and of course, what that did to demand. And that is already fading because of demand destruction from prices and, of course, as people run out of money. So I think it's all one and the same. And look, the trickiest part here, John, is that, do we decide, is there going to be a window of opportunity between the end of the Fed hiking cycle and the recession itself? This summer we wrote about that. We said it's too early to think about the Fed ending its rate hike cycle, so we didn't try and play that rally. This time, though, we think there could be this little window of hope, particularly at the year end when there's pressure to perform and people have to chase stocks in the year end potentially. And as Taylor was saying, the midterms historically are a positive catalyst for at least for the month of November.
Well, let's talk about where you want to be long within the equity market. The recent outperformance in the equal weight S&P over the last couple of weeks is clear for all to see. What's the signal you take from that, Mike?
Well, I think that the equity market leadership is fading, right? So technology has been a massive underperformer this year. Consumer discretionary as well. We've been underweight those groups. And the question, of course, is what's going to take over? And I think what's interesting, what we're trying to do, John, is, we look at the internals of the stock market to help guide us. And we're getting close to the end of the bear market. We're not there yet, but what you want to try and figure out is what outperforms in the last leg down, and because that will tell you what's going to outperform in the next leg up eventually when we get there. And that's been industrials, financials, and some of the commodity complex. And that makes perfect sense to us, right? In the next economic expansion next year, we think that there will be a major leadership change from the former leaders to these new areas.
You think tech gets left behind?
Well, look, the reality is that there are plenty of good tech stocks that will be fine. The reality is that there's too many of them, right? And they got overvalued. So it's not that technology is dead in terms of the spending trends. We're very bullish on technology spending. However, there's too many competitors now, and the valuations just got out of whack. So we got to take that out. And yeah, so there'll be a lag. There'll be a laggard probably in the next recovery cycle, but that doesn't mean there aren't great single stock opportunities within that.
The midterms, let's go there. It was in your note this morning. Is that just a risk event, Mike, we need to clear? Or does it have outcomes that have consequences one way or the other?
I view the CPI as kind of this risk event that needs to just get it out of the way. It's sort of like, who cares? It's backward-looking data anyways, but we got to get through it, and then we're pretty confident that 6 months forward, inflation will be materially lower. That's our forecast, and so it's just that's kind of the risk event that just has to come and pass. The midterms, though, however, could have lasting implications if it's a decisive victory for the Republicans, because as I said before, we think the majority of the inflation spike was a result of excessive fiscal spending, and that, of course, will be curtailed even if the Republicans just win one chamber. That's not to say that the Republicans are fiscally conservative incredibly fiscally conservative, but it does throw a wrench into this idea of a single party, which the market also likes, the idea that no one party having single control. So ultimately, it should be good for bonds. Bond yields lower has been key to our tactical rally call, as you know. And look, I want to make it perfectly clear, John. If we don't get rates to come down, the rally's over. We had it 39, 39.50, but we see enough in the tea leaves and enough in the technicals to suggest we should hang out and see these two events this week play out first.
Mike, different views though, and you've written about this in the past, so I'd love your view on it now. Are rates going down because there is this increased perception that the cycle's ending, the hiking cycle's ending, or are rates going down because perceptions of global growth are rolling over? And in the near term, I get it, you trade on just the move, but when do you start to trade on the reasons for the move into next year?
Yeah, look, so we have to kind of serve many constituents. This is a trading call, okay? For our core, kind of view, we remain of the view that the bear market is not over, primarily because of the view we've had all year, which is that earnings ultimately will decide the end of the bear market. And we think earnings expectations for next year are significantly too high, maybe as much as 20%. And that will happen over the next 3 to 6 months, meaning the numbers will finally come down. Part of the reason we threw in the towel on that happening now is because we just got a sense that companies wouldn't talk about 2023, which they did not, and therefore the earnings remain high for next year. But I want to make it clear, over the next 3 months, we think that will change. We think companies will discuss 2023, and the reality will set in that the numbers have to come down. That will form the bear market low probably sometime in the first quarter next year.
Are we seeing signs of that now with some of these tech companies, Mike, reporting cuts, hiring freezes or layoffs?
Well, let's separate that because first of all, we saw many of these large tech companies report, pretty weak third and fourth quarter. But then when you actually look what happened in 2023 numbers, they didn't come down that much, at least for the majority of them. And part of that's just, kind of laziness of the numbers. Nobody talked about it, so they just kind of keep them there. But then I want to talk about the cost cutting. Okay, so look, this is what will get us bullish. By the way, if we saw more aggressive cost cutting, not just by the tech companies, but by companies more broadly, this acknowledgement that we have a cost problem. And, obviously we don't want to see people get fired, but, layoffs, unfortunately, are a part of that slowdown. When that layoff cycle picks up in earnest, that will actually be one of the keys for us to get bullish because that means the bleeding will stop on the operating leverage.
Final question. You hinted at the answer to it a little bit earlier in the interview. I've asked this question all morning, Mike. You get the choice, the outcome of CPI or the outcome of the midterms right now. I can give you one. What would it be?
If I could see it right now, Clarence speaks, I would say I'd probably rather see the midterm election outcome because that has more lasting impact potentially.
Mike Wilson, thank you, sir. As always, Mike Wilson there of Morgan Stanley, still looking for that bear market rally to continue through the next couple of months. Equity futures were positive going into the open. We come out the other side about 11, 12 minutes into the session. We're positive 0.2%. In the cash equity market on the NASDAQ, we're basically unchanged. Coming up, debate over China's reopening plans, reaching a fever pitch.
I'm not quite sure what a pivot on COVID lockdowns quite means in China yet, but it's certainly not going to be a sudden reopening as we saw in the Western world. It's going to be more nuanced.
And the latest on Apple's production difficulties, that conversation up next.
I'm not quite sure what a pivot on COVID lockdowns quite means in China yet, but it's certainly not going to be a sudden reopening as we saw in the Western world. It's going to be more nuanced. And as such, I'd be a little bit cautious about some of the optimism which is happening in Hong Kong.
Economic headwinds piling up as China doubles down on its COVID zero policy. Health officials saying previous practices have proven that our prevention and control plans are completely correct. This as the demand slowdown worsens, China's trade taking the hit, with exports falling and imports shrinking for the first time since 2020. Mike McKee and Damien Sassower here with the latest. Mike, morning.
Good morning, John. Well, you can easily see what the problem is with China. They have been much more strict than the rest of the world. When you take a look at the stringency index, the measure of how tight their policies are on locking down, the U.S. and I just picked Germany have fallen tremendously, and we're pretty much reopened, whereas the Chinese, you can see, are still very, very tight, and that's having impacts across the board, not just on trade. You mentioned the exports and imports, but Chinese growth remains really slow. Their trade surplus widened because imports are so low at this point. 10% of China's GDP still under lockdown, according to Nomura, and there are rumors of a COVID zero policy change that, as you mentioned, are being shot down by the government. So nobody quite knows what's coming out of China, except that some companies like Apple are having problems.
There was a massive frenzy last week, Damien Sassower, in the market off the back of these hopes. What's the truth to all of this, Damien?
Well, first of all, I don't know what the big surprise was. I mean, it was obvious that exports were going to get a hit here. I mean, look at South Korea. Exports declined for the first time in 2 years. Look at freight rates between Shanghai and Los Angeles. They're down 80% over the last year, Jonathan. So things were boiling to a head. But to your point about the equity market action last week, look, what it says is you've got very, very light positioning from foreigners in China. And so it doesn't take a whole hell of a lot to move the needle. And that's exactly what we saw. Look, I mean, I'm not suggesting that there's real value in China right now, given the geopolitical and legal overhang and the property sector, of course, but the reality is light positioning makes for easy markets, and so I think that's a lot of what we're seeing here.
Well, it was a messy market over the last few years, that's for sure. Damien, Mike, thank you. Mike mentioned Apple. Let's talk about Apple. The COVID zero policy in China weighing on multinationals. Apple feeling the pain and seeing significantly reduced capacity due to COVID restrictions. This coming amid a Bloomberg report blaming demand woes for at least 3 million in total production cuts for the iPhone 14. Ed Ludlow has to make sense of this. Morning, Ed.
Yeah, good morning, John. Apple down for a sixth straight day, its worst run of declines since January, the stock trading at its lowest level since June. You're right, two key pieces of news, one on the supply side, one on the demand side. Let's start with the demand side. Apple expects to produce 3 million fewer iPhone handsets this year. According to sources, it's instructed its suppliers to build 87 million, down from 90 million. And according to sources, that is principally due to softness in demand for the lower end base iPhone 14 handset models. You'll remember in September, Apple had actually originally instructed its suppliers to boost output of the iPhone overall, but then walk those back when we got those initial pieces of soft demand. And then at the same time, there's the supply issues too. Apple said Sunday that shipments of the premium iPhone 14 Pro models will be lower than expected due to COVID lockdowns, in particular in the Zhengzhou region, where Foxconn, its principal assembler, has the bulk of their activity for the Pro models, the higher end versions of the iPhone 14. Apple also warning customers globally that as a consequence of this, there will be an extended waiting period to get your hands on an iPhone 14 Pro model. Why is that important? We're in the final 3 months of the year, the key holiday season. The street very much worried not just about volumes, but about the bottom line as well, because the net result of this being fewer handsets is also the mix will change. Fewer shipments of the higher ASP, higher margin Pro models should impact the bottom line. There's also a really interesting take from UBS on this, John, real quick. They're saying that the market has not yet factored in these disruptions in China for fiscal 1Q or full year 23. And that actually, according to UBS, the market is, quote, way too optimistic in its revenue and earnings projections for Apple for this year, which indicates actually we should take this much more seriously than the street currently is.
Ed, how seriously are they taking it? Are they rethinking production in China?
Yeah, I mean, we already know the story here, right? Particularly as it relates to Foxconn, the main supplier that assembles the iPhone. They're trying to shift away from a reliance on China to India, but the reality is that 80% of these higher-end iPhone 14 Pro models are assembled in the Zhengzhou region. This is an area that we've reported on, right, where they've been hit hard by quarantines. Workers have fled the region because they can't get into their workplaces, and right now the government, relating to what Mike was talking about on the policy side, only are allowing medical personnel onto the streets of that city. It's impossible to run a factory in that scenario. So yes, long-term Apple looking outside of China and towards India principally.
Apple down for a sixth day. Ed, thank you. We're down by 1.8%. Ed talked about the analyst community. B of A, Barclays, both cutting targets this morning. Deutsche Bank lowering Q1 estimates. JP Morgan saying Apple. And the latest news implies downside to Q1 estimates as well. Just a range of analysts rethinking maybe the story on the margin. The S&P up by a little more than 0.1% with a sector price action. Back with us. Here's Katie.
Well, John, the S&P 500, it's just about flat, but you actually have 8 of 11 sectors higher right now. Energy is out in front. You do have crude back to flat, and like we talked about, you have U.S. natural gas surging this morning. Consumer discretionary to the downside. That's a lot of the travel names. But the story this week, of course, is the U.S. midterm election. So let's look at what the sector action looks like in the run-up. Over the past week, it's interesting. You have aerospace and oil services, those pipeline companies. They've both rallied relative to the S&P 500. Not fantastic gains, but for context, you have the S&P 500 down about 2.4% over the past 5 days. On the other side of the trade, you have green energy, those cannabis companies, both trailing the big benchmark. So it could be a sign that markets see Republicans winning control of Congress. But, John, your guess is probably as good as mine.
I don't have a guess right now, Katie. Clueless. As always, Katie, thank you. About 20 minutes into the session, equities down now on the S&P by 1/10, on the NASDAQ by 0.4%. In the bond market, up 6 basis points at the front end. Your 2-year all over the place last week, close to 480 post payrolls in the first few minutes. Then the lows of last week, close to 440, right now 472. 472. Highs we haven't seen in the last week, going all the way back to maybe 2007. Up next, your trading diary from New York. This is Bloomberg. 25 minutes into the session this Monday morning. Good morning to you. We are basically flat on the S&P, negative 0.2 on the Nasdaq 100. Some losses this morning, marginal losses on the Nasdaq, and adding to the losses of last week, down 6% on the Nasdaq 100. Worst week going all the way back to January. The bond market looks like this: 2s, 10s and 30s, your 2-year. Look at the front end, up 6 basis points again and back through 470, 471, 75 on a 2-year, just off the highs of Friday, which were close in and around 480. That's the price action. Let's get you the trading diary. Big week ahead. White House press briefing coming up at 1:45 Eastern time. Fed speak picking up with Collins, Mester, Barkin all on deck. US midterm elections on Tuesday. The results on Wednesday. Might take longer than that. Then we get more Fed speak. Williams, Barkin speaking on Wednesday too. And finally, jobless claims, followed by another big CPI print in America. CPI Thursday, just around the corner. From New York, equities basically unchanged. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
About that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It
It is 30 minutes into the U.S. trading day on this Monday, November 7th. Here are the top market stories that we're following for you at this hour. T-minus 24 hours. U.S. midterm elections around the corner. The House expected to go red, Senate up for grabs. We get the latest on the horse race. And midterms, a catalyst for markets. Mike Wilson of Morgan Stanley sees more of a bear market rally ahead of the elections. We're going to game out how to trade and where the risks are. And tech layoffs. Sorta. Twitter lays off people, asks some of them back, and Facebook could cut workers as early as Wednesday. We're going to speak to Brad Smith, Microsoft president, to get his take on the industry. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. Guy, just focusing on the midterms, I think that Lori Calvasina of RBC said it best in her note. The bigger the Republican win, the bigger the equity surge.
Absolutely, which seems quite logical in a way, doesn't it? You are going to get divided government, you're going to get less spending, you're going to get less inflation. That feels like a logical way of working this one through. I guess my caveat to all of that would be kind of what Evercore has said today. You get any kind of political concerns about the validity of the election, then all bets are off. I think that's going to be something to definitely watch out for.
Yep.
It's not as if the US has had a great track record recently with elections, and as a result of which you can't ignore that as a factor.
100%. And also, I mean, we probably may not know who's going to win the Senate by Wednesday. So will that uncertainty either cause volatility or just put off any kind of rally we may get on a gridlock Congress? I don't know. I think that these are the questions to tackle.
Yeah. And I think you've got to look state by state. I think you've got to look at region by region just to figure out what's going on here. All of this is going to be important as well as we think about what's going to be happening going forward into 2024. Because yes, by the end of the week, I suspect we're going to be talking about that as well. Mike Wilson of Morgan Stanley out with a note as ever over the weekend, putting his finger on it, basically saying investors should stay bullish on equities ahead of this week's US midterm elections. Today's question of the day, what is the midterm trade? Let's try and get an idea of how you should be positioning, what you should be saying and thinking as we work our way through this process. Bloomberg's Vincent Signorella joins us, as does Bloomberg's Simon White of the Market Live blog. Simon, I'm going to start with you. You've got two big events coming up this week. You've got the midterms, you've got the CPI. Just talk me through the midterms from an inflation point of view, sort of through that perspective, because that's what the market's big concern is right now. Inflation is what affects everything. So how does this affect inflation?
So I think the big change came with COVID. The attitude to crises was to spend more money, and which meant that the US government, along with other governments, kind of lost fiscal credibility. And so that means the response to governments borrowing more is very inflationary, much more than it used to be. So if you get any other result in the status quo, after the midterms tomorrow, then I think you've opened up the opportunity for less fiscal spending, which should mean less structural inflation risks. But I also think that the kind of attitude might change politically, that the pressure now has been very much in the cost of living crisis. And coming out to the midterms, once the midterms are out of the way, that pressure might be relieved. So there might be less pressure on the Fed to keep up this very extreme hiking cycle. So I think some of the data that we'll see in subsequent days will kind of begin to test that.
Hey, Vince, talk to me then about what you think the trade is. And I'm kind of leaning towards the dollar if you want to go there, because I still can't quite get a grip on why the weakness we've seen the last couple days.
But the weakness in the dollar, it's just simply the inverse correlation with the S&P 500. As you see risk rise, the dollar will sell off. We're seeing bouncing off the lows a little bit today because we're seeing a little back up in yields. And of course, higher yields do tend to support the dollar. But I think if Mr. Wilson is correct, and I think he is, if we do see a Republican majority in the House and the Senate, we will see a risk rally. We will see the dollar roll off. And it's going to be twofold. Number one, markets absolutely love when Washington does nothing. And so we'll have a lame duck president and a Republican House and Senate. And about the only thing that's going to get accomplished will be positive for equities, which, as Simon mentioned, lower spending. But one thing no one is talking about really is the potential for resurrection of drilling, the Keystone Pipeline, all positives for energy and all positives for the reduction in energy costs, at least from a psychological standpoint. It's going to take Keystone years to come online. But if the Republicans manage to put that back in the game, you're definitely going to see energy prices moderate and you're going to see inflation moderate. That's going to help the Fed a lot.
Simon, let me come back to you on one of the stories that we mentioned right up at the top, and that is the risk of political instability. Markets do not like
political instability. We've seen it in the UK, we've seen it elsewhere. The United States has a recent track record with it. If this week turns out to be turbulence, how big a market reaction could you get? How much of a risk-off reaction could you get?
Well, the market has been quite skittish of late. Like we've talked before about poor liquidity in the treasury market. So any kind of vacuum of information is not going to help that. One thing I've been looking at, for instance, is the kind of preternaturally low level of the VIX. On any way you want to look at it compared to cross-asset volatility or at-the-money volatility, it just looks very low, and it's been trading off again. So I think any kind of change to the environment after the midterms, or certainly any volatility or uncertainty, you could start to see that start to move. And as I say, you could see larger moves in yields because of that terrible liquidity that you have in treasuries.
So to that point, if we do get uncertainty and we do get that volatility event, is the dollar in that instance a safe haven or no?
Yeah, I think it would be. I think there's going to be very few places to turn if we get this kind of major risk-off, major political disadvantage, if you will, with the turmoil, not knowing what the results are. And, some states have already warned, Pennsylvania in particular, that the results are not going to be known the day after and maybe take days to come. And that just creates a little bit of an angst, I think, in the voting public and confidence-wise, where, you start to see people, create these rumors, if you will. And that is certainly not positive for global equity markets, not just here in the States. So you're probably going to see some sort of a risk off, some flight to the dollar, at least in the near term, until the results are certain. And then even when the results are certain, will people believe them? Will the losers in the elections admit that they've lost those elections, or will they cause some trouble afterwards? We've seen the pattern where when the election is finally decided, the person on the wrong end of it just doesn't say it's real. So it could really be a big problem.
Simon, you mentioned the Fed a moment ago. You postulated that the election could take the pressure off the Fed to act more hawkishly. Could you see it the other way around, which is that this will remove some of the politics, some of the noise around the Fed recently, and allow the Fed to act in the way that it wants to act?
Yeah, potentially, but the environment that we're in now is, I think, the risks is shifting the other way. Like every indicator I look at of inflation is seen it turning lower, and I really think you'll start to see more kind of pressure on that in the near future. I think growth also is going to continue lower. So, and I don't think the Fed particularly likes hiking rates. I mean, it's almost like they like to give people stuff, not take it away. Give them punch, not take away the punch. Mm-hmm. So I think, if anything, that they're looking for an escape route. They've talked very tough. I've been very surprised at how they're tough talk, but then they've not really been challenged because they've not really been challenged by the growth. Like the worst case when Volcker was hiking rates, he had to have an armed guard, right? That's how bad things got. Powell's kind of nowhere near that situation right now, right? He's never had to hike into an extremely difficult economy, so he's not really been tested. So I think this is just getting going, really. This is going to be the next 3 to 6 months are very interesting. We'll see if the Fed puts its money where its mouth is.
Guys, thanks a lot. Really appreciate it. Thanks for setting up the week for us. Simon White and Vincent Signorella, appreciate it. Thank you. So coming up, more on our question of the day. What is the midterm trade? We're going to be talking about this throughout the next 2 hours. Katrina Dudley, Franklin Mutual Advisors Portfolio Manager, joins us next. This is Bloomberg.
Window of opportunity between the end of the Fed hiking cycle and the recession itself. This summer we wrote about that. We said it's too early to think about the Fed ending its rate hike cycle, so we didn't try and play that rally. This time, though, we think there could be this little window of hope, particularly at the year end when there's pressure to perform and people have to chase stocks into year end potentially. And as Taylor was saying, the midterms historically are a positive catalyst for at least for the month of November.
November 8th as Americans decide the future of Congress and state legislatures. Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections.
We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
After the midterms, and this next 6-month period of time tends to be the best season for equity markets.
You don't want to take money out of the market here.
I want to see if this rally ends here because this is a significantly lower high.
People have been, for the most part, underinvested.
I think the real challenge is finding out what is the least painful way of addressing inflation right now.
Many people in a midterm election year don't agree that we're in recession now.
We still think that there's some pain in front of us, and so we think this is really more of a good time to reposition.
Those are some of our guests weighing in on how they expect markets to react to the U.S. midterms, which takes us to the question of the day: what is the midterm trade? Joining us now, Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. Joining us now, Katrina, midterm trade, what is it?
Look, let's just be honest about what drives markets, and it's profitability. It is not the elections. The elections are a coincident indicator, but we really need to look at what those policies mean in terms of underlying profits of companies. So first of all, I think it's pretty much given that the Congress is going to change hands, and the question is really in the Senate. The likelihood, though, is that we're going to kind of have a mixture of Republicans and Democrats in charge here, and some of the things that we look at are the Inflation Reduction Act and whether or not maybe that gets overturned, but there's so much political will and so many good policies contained in that I think that we've got so many drivers of the market going forward and really not a lot of resistance to making any change to that act and the good changes that we see coming ahead.
In terms of what else could be reducing inflation, let's just talk about government spending. As we were discussing in the last segment, government spending has been a huge factor in terms of how inflation has developed. Do you think government spending will be lower? Do you think fiscal policy will play a less important role going forward? And if so, how do I pivot around that?
What we saw during the pandemic was that our monetary policy was transmitted into the economy through fiscal policy, and a lot of that was through the handouts. What we have seen, and someone smarter than me indicated, is that when you have a helicopter that drops a lot of money from the sky, you will have coincident inflation, but with some part of a lag, and that's what we're seeing at the moment. Obviously now we don't have that kind of helicopter just dropping those large amounts of money out of the sky. And what we've got is more tempered policy, and it's policy that's really aimed at making investments that will make America competitive going forward. And I think that that's really important because as we look at the market and we look at it as a discounting mechanism, I think there are a lot of positive things that are happening in the United States that are investable themes, and that we will have this tempering of inflation, which is a result of these forces going away, as you said, not having as much fiscal stimulus, as well as having some really good policies. Yes, they are fiscal stimulus because it's government spending, but it's in a much more targeted and direct way.
Katrina, on that point, let's just hit on energy for a moment. If there is a divided government, you maybe see the windfall tax thing really taken off the table. Maybe we see more legislation about more drilling and drilling on federal lands, etc. Is that a tailwind for the energy industry? Or is sort of like the quote-unquote damage done in terms of how D.C. is going to deal with the energy guys?
I don't think that we will see a windfall tax. If you just look over what's happened in the UK and you look at the reaction that they've had, that is the first kind of check mark against this, that we think it won't happen. The other thing that I don't think people are aware of is that the Inflation Reduction Act was energy agnostic. And so it didn't actually favor one type of technology over another technology in terms of solving our long-term energy crisis and shifting us into more sustainable and more environmentally friendly sources of energy. So I think that we have this optionality that's being created in the market. It will mean that innovation wins, and that's one of the areas where America has really excelled. We have innovation in our companies, we have an innovative workforce, and we actually see a situation where the U.S. could become an exporter of energy technology to help other regions lower their cost of energy and do so in a way that is environmentally sustainable.
Katrina, does that compensate for the tech turmoil that we're seeing right now in more traditional technology? Is that going to roll off and what you're talking about in terms of energy tech rolls on? Is that how we should think about this trade?
Look, I think what you're seeing in a number of these technology names that have really adjusted is the fact that a lot of these companies are not necessarily tech companies as we think about them. They're really consumer derivatives, and they're product-related consumer derivatives in many different forms, be it that they're advertising products to consumers or they're actually selling them in the case of Apple. If you take a look at the consumer discretionary sector, you've had the services sector hold in very, very strongly, and you've had the consumer goods part of it trade off. And I think that what you're seeing in the technology sector is a combination of that on the kind of product side or anything related to product advertising. And then you've also had this other element, which we've talked about a lot, which is the idea is when you have rising interest rates, it disproportionately impacts the valuation of any company where the cash flows are just so far out into the future.
Right.
It means that they discount in at a lower rate. So I think the market is being very, very rational in how it is adjusting for the factors that we're seeing happening at the moment.
So to that point, if we've seen a top in yields or we're around a top in yields, at some point, does that make it attractive to buy tech, or do you need to wait for them to actively fall?
I don't think you're going to see rates actively fall in 2023. I think that's more a 2024 type of situation. I'm not necessarily sure either that the Fed is completely done with raising rates. I think that we're looking at probably 50 going into the end of the year and another maybe 25 in the early part of 2023, because inflation, even though we're starting to see signs that it's coming down, it is still significantly higher than when the Fed wants it. And they've been very deliberate in their communication that they will use monetary policy as their tool to control inflation. So once you do have, however, the stopping of the rise in rates or the expectation that it's going to stop, and you have those new rate and that new rate term structure priced into the market, I think you're going to start finding some opportunities in tech stocks where they've priced in this new regime.
Katrina, we really appreciate you jumping on with us. Thank you very much indeed. Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. Thank you very much indeed. Still ahead, we're going to talk tech. Apple shares falling after the company says it expects to produce 3 million fewer iPhones this year, thanks to softer demand. We're going to have details of this story next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Twitter is asking dozens of employees it laid off last week to please come back. Elon Musk cut close to 3,700 employees last week to slash costs. Bloomberg's learned that some were laid off by mistake and others were let go before management realized they may be needed to build the new features Musk wants. Facebook parent Meta Platforms reportedly will start laying off thousands of workers this week. According to the Wall Street Journal, the job cuts could come as early as Wednesday. Meta has been struggling with growing losses, plus it has been investing heavily in developing its metaverse business. Shares down some 73% this year. And Bloomberg has learned that Apple expects to make at least 3 million fewer iPhone 14 handsets than originally planned for this year. The cutback is due primarily to softer demand for the iPhone 14 and 14 Plus. Apple and its suppliers now aim to make 87 million of the devices or fewer. And that is your latest business flash, Alex.
All right, thanks so much, Ritika. Let's get more on this with Bloomberg's Ed Ludlow joining us now. Hey, Ed, how much of it was demand versus how much of it is a supply issue at this point?
Yeah, it's a pretty equal split, right? Let's start with the demand side and Apple instructing suppliers to lower its production target for this year to $87 million. There's a real emphasis on the lockdowns in China, basically hampering the lower end of the demand curve, right? This, we're told by sources, is a lowering of expectations because the base model iPhone 14 has not gained as much traction with consumers as originally anticipated. There's softness in demand. And then equally on the supply side, the thing that consumers want, the higher end iPhone 14 Pro models, are being restricted in their supply because of the lockdowns and COVID zero policy in Zhengzhou, a key region for Foxconn's assembly operations, which means going into the holiday quarter, it's a pretty disastrous mix of factors for what Apple's trying to achieve.
Ed, is the product just not good enough? There was always concern around the 14 that it wasn't a big enough evolution. Are we now starting to see the impact of that?
Well, what we're seeing in the behavior of consumers is that they are favoring the higher end iPhone 14 Pro models. The Pro comes with the sort of higher specification and more, I guess, new features. The iPhone 14 base models, frankly, differentiated very little from the previous generation of handset. It's interesting as well because it represents what we're seeing in the consumer electronics market. There's resilience at the higher end of the market, a lot of softness at the lower end of the market across all handsets, not just Apple, right? Talking about Samsung and some of the domestic Chinese manufacturers as well.
Ed, I'm curious as to if we think the demand is just delayed or is it gone altogether? Because I've been hearing about the super cycle for years at this point from Apple, and I'm wondering if this just pushes it out again or if we just need to rethink that thesis altogether.
Well, the super cycle was driven by the upgrade to 5G networks, right? And I'm laughing because I used to love annoying John Ferrer of this every morning for the last 18 months on the 5G super cycle. The question is what drives upgrades now? And to Guy's point, there's not a whole lot of new technological functionality that's doing that. If you look across the analyst community and the reaction, the one note that jumped out at me is UBS, and they basically feel like earnings and sales projections for the fiscal full year 23 are, quote, overly optimistic. In other words, we're not currently factoring in how severe this slowdown in demand is right now. And in particular, in Apple's case, we're not looking at how that will impact Apple's financials going forward. So I think the message from some of the more bearish elements of the street is actually this demand degradation, I suppose, is going to get worse.
Ed, do people spend more money on other stuff? Do you upgrade your AirPods? Do you upgrade everything else if you're not upgrading your phone?
I think that's what was so interesting about Apple's earnings print last week or the week before. I lose sense of time and space, but it was a mixed bag. There was an overall beat because of strength in Mac, but there was weakness in the services part of the business, and in particular, weakness in the iPhone handsets business. You have to remember what Apple's trying to do, which is to encourage users or customers to own all of them, build products into an ecosystem. That hasn't really come true yet.
Ed, you're going to join us in the next hour. We've got plenty more to talk about. Elon Musk making some comments about his views surrounding the upcoming midterm elections. Talking of which, polls, of course, are going to be opening tomorrow. Terry Haynes from Pangea is going to join us to discuss. This is Bloomberg.
about an hour into the U.S. trading session. Really can't find a clear footing here for equities. Bloomberg's Emily Grafeo is tracking those moves for us. Emily?
Hi, Alex. Yeah, a little bit of a choppy trading session here. We do still have the S&P 500 higher, but only up about 0.1%. NASDAQ 100 now underperforming as those U.S. Treasury yields move higher, seeing a lot of movement in the shorter end of the curve, and the dollar lower. Still a little bit of risk on today as traders prepare for the midterm elections. We are seeing a number of strategists talking about a bear market rally after the election. Morgan Stanley's Mike Wilson is one of them, but it's going to be a short-lived rally, according to Wilson. Taking a look at some of those individual movers, particularly in the tech space, we do have Apple lower today. This is after they announced they're planning on cutting back the production of their iPhone 14s. Meta, a different story, actually now up over 5%. This is, of course, when they're planning on potentially laying off what could be thousands of workers as early as Wednesday. We're also seeing the ProShares Ultra Pro QQQ ETF. This is a $10 billion ETF. It provides 3 times the daily performance of the NASDAQ 100. Had a really big inflow last week, but now coming off as the NASDAQ 100 moves lower. I've been thinking a lot about mega cap technology and their influence on the S&P 500 and the broader market. It's felt like for the last few years, the S&P has really needed those large cap technology stocks to move higher. But you take a look now at the cap weighted index divided by the equal weighted index. As the ratio moves lower, it basically shows that mega caps are having less of an influence on the broader market. Perhaps that equal weighted index now, as the tech stocks get smaller, is where investors want to be when they want that exposure to large cap technology stocks. And one last look at another part of the market I'm watching. Natural gas futures surging, now up over 11% on some news of weather in the Pacific, and we're seeing that also reflected in energy stocks moving up higher. Guy.
As I keep telling Alex, it's all about the weather. Emily, really nice. Thank you very much indeed. Emily Grafeo, great stuff. Okay, let's get back to the politics. Let's talk about what is happening. The U.S. midterm elections are expected to usher in a new era of divided government. Polls certainly show Democrats losing control of the House, possibly the Senate. President Biden hit the campaign trail this weekend, trying to drum up support, of course, for his party.
Democracy is literally on the ballot. I've been making this case since I ran. You know, there are more than 300 Republican candidates for state, local, and federal office who are election deniers. These deniers not only trying to deny your right to vote, they're trying to deny your right to have your vote counted.
The president certainly hitting the road and visiting lots and lots of places over the last few days. This weekend, of course, in New York. Anne-Marie Hordern joins us now from the White House, our White House correspondent, with the leaf blowers, I'm assuming, behind her, judging by what is going on. Anne-Marie, New York, red or blue?
I'm battling 3 leaf blowers, actually. So New York is deep, deep blue. And this is why it was so shocking to see the President of the United States Sunday evening before the elections on Tuesday to be in Bronxville in Westchester County, really trying to drum up support for the incumbent governor, Kathy Hochul, who, she took over from Mr. Cuomo, and she would then be the first elected female governor of New York. But he wasn't the only one. We also had former President Bill Clinton, former Secretary of State Hillary Clinton, the Vice President Kamala Harris. They have made stops in New York. And I think that just shows the tone and the shift of the concern of the Democratic Party, the fact that they feel the need to go out to New York. It can also show the fact that there are some individuals and candidates running either state elections or federal office that do not want the president to be alongside them because their constituents view what is going on with the election and they view that their vote as a referendum against this White House.
Anne-Marie, what's President Biden's then schedule over the next, say, 24 hours? And what's his mood on Wednesday?
Well, this evening he's going to be going to Maryland, and he'll be there campaigning for Wes Moore, who looks like he has a very good chance in the polls to be the governor of Maryland. Even the current incumbent Republican moderate, Mr. Hogan, has called Mr. Moore's challenger, the Republican, quote, nuts. So this does look like this could be kind of a fun evening for the president. The president also has an international trip at the end of the week, and whether or not he gets on Air Force One in a happy mood or not will really depend on Wednesday's results. We should also note that we may not have the full composition of what Congress is going to look like until potentially December. Georgia, that Senate race is a key race, and it potentially looks like it could go into a runoff. So there's going to be a lot of questions in the air over the course of the next 48, 72 hours.
All right, Anne-Marie, thanks a lot. Really appreciate it. Bloomberg's Anne-Marie Hordern joining us there. Let's get more here. Terry Haynes, founder of Washington think tank Pangea Policy, says the election is 60% likely to yield an all-Republican majority in Congress. Terry joins us now. First of all, Terry, it looks like we're going to get a House that's Republican, Senate up for grabs. Two questions. When do we know the result of this election, and how red do you think it's going to be?
Let me answer the second one first, Alex. I think you're going to see a little red. I mean, my prediction, as you say, is 60% likely that you're going to see an all Republican Congress. But I want to caution a couple of things for markets. One is that you may not see a Senate result before the end of the week. You know, there are basically, nine races that are, including the Georgia race, that are very, very close. And, that's almost 1/10 of the entire Senate. So, I think you're going to end up seeing at most a Republican Senate of maybe +2, +3, so they pick up a few. But if it's even closer than that, you may not know until the Georgia runoff on December 6th. So I caution a couple of things. One is that it's very unlikely that you're going to see anything right away. I mean, so markets won't get instant gratification or the clarity that they really want early. Secondly, that Republican majorities really aren't control. They're majorities. And as I often say on your air, think of the parties as factions more than anything else. It's going to be hard for Republicans with small majorities to coalesce around things, just like it is and was for Democrats. So, you've got those problems.
Terry, is this election in any way going to be contentious? Is there going to be a problem with any of these results?
I expect you'll see a few recounts. I don't think there'll be any major problems. A lot of what's been said here over the last week in particular is that, any desire to want to enforce existing election laws comes down to voter suppression. That's certainly rhetorically overblown, and I think really doesn't affect the races in any way. I expect the races to be done fairly. I expect the states to take their time and do it right. Pennsylvania, one of those close races, the Secretary of State of the Commonwealth is already saying that the races will take a few days to sort out. So that gives you kind of an empirical idea to support what I just said about a lot of these races taking a while. But I don't expect them to kind of blow up into full-blown slanging matches.
I hope you're right, Terry. I really do. Lori Calvasino over at RBC was saying, the redder the wave, the bigger the market rally. Do you agree with that?
Well, in the abstract, sure. One thing I would caution anybody that's looking at this is that I don't think there's going to be a really huge wave. The wave talk is rhetorical. It's meant in large part to stoke turnout. For Republicans, a red wave is a big talk. For Democrats, kind of avoiding a blowout, means they've survived to live another day with, not really that much harm. And both of those results, are ones they've been preparing for some time. I think what you'll end up with is as I say, a Republican majority of roughly 20 seats in the House and 2 to 3 in the Senate, which always looks big to markets. But when it comes down to it'll be traded that way. But when it comes down to governing in a couple of months, it's not going to look like it's anywhere near able to accomplish as much as markets think today.
What does that scenario mean for the Fed, Terry?
One thing I think it means for the Fed is they can continue to go on and do what it is that they're doing. My contention all along has been that the Fed leadership and the 5 of the 7 governors that were confirmed or reconfirmed this summer needed to keep their heads down until they were confirmed. And basically about 1 minute after they were confirmed, they moved in the hawkish direction that they continue on today. You see Democrats in the Congress right now, Chairwoman Maxine Waters being the most prominent of them, complaining that the Fed's going too far on trying to tamp down inflation. I expect Republicans to cheerlead the Fed along a little bit and support what they're doing, frankly.
Hey, before I let you go, we got a question from a viewer earlier that talked about a split U.S. government, et cetera. Does that lead to another debt ceiling crisis? That's something I've been reading about, too. You're smiling. Did it happen?
I think in the end they avoid that. There's always heated rhetoric that surrounds this. But bottom line is, ever since about a decade ago when the rhetoric escalated to the potential of a real default, both parties in the end have wanted to avoid that. I continue to expect that to be avoided. But markets should anticipate getting rocked a little bit as the arguments go back and forth.
Terry, always great to catch up. Really useful to get your insight as we head into voting tomorrow. Terry Haynes, Pangea Policy founder. Coming up, more than 100 world leaders are in Egypt for the United Nations Annual Climate Change Summit. We're going to look at what corporate leaders are doing to solve some of the climate crises that we see around the world. Microsoft's President Brad Smith joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky wants Iran to be punished for helping Russia. Zelensky said if it wasn't for Iran supplying weapons to Russia, quote, we would be closer to peace now. Both Ukraine and the US say that Russia is using Iranian drones in the war. The northeastern U.S. is hurtling towards a winter heating crisis. Heating oil delivered to New York is the priciest ever. Retailers in Connecticut are rationing it to prevent panic buying, and there are warnings of a natural gas shortage. Add it all up, and northeastern consumers face the highest energy bills in decades this winter. And Europe's dash for gas in Africa looks likely to become a heated issue at the climate change talks in Egypt. One activist says Africa won't accept energy colonialism. The EU's been accused of using the continent as a gas station as it seeks alternatives to Russian oil and gas. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right. Thank you so very much, Ritika. So Microsoft President Brad Smith is also in Egypt for COP27. Bloomberg's Emily Chang is in San Francisco, and both of them join us now. Emily, I'll take it over to you.
Alex, thank you so much. And Brad, thank you for joining us all the way from Egypt. You're, of course, leading Microsoft's COP27 delegation there, and I know that your climate fund is now about halfway through. So far, what have you learned? What's worked and what hasn't?
Well, I think to me the number one lesson from our Climate Innovation Fund, which is a $1 billion investment fund, as you know, Emily, is really that we're on the cusp of a huge transition as a global economy. In part, the carbon and climate transition is an energy transition. So that means that new technologies that are bringing better renewable energy online are really important to the future, and hence you would say good things to invest in. That includes not only sources of renewable energy, but things like sustainable aviation fuel, another area where we've made an investment. There's a whole variety of other climate technologies that clearly are going to be the big names a decade from now. Nobody has a crystal ball that can exactly pinpoint which one, but we're seeing new markets emerge. And it's not just what we're doing to reduce emissions, it's now carbon removal. Take something like Climeworks. This is a Swiss company that we both invested in and are purchasing from. It is innovating in what's called direct air capture, technology that takes air, removes carbon, deposits carbon underneath the earth. It's just an indicator of how much technology innovation is part of all of this.
Now, you've hired researchers in the Global South to combat the sustainability skills gap, if you will, and you've made this pledge to try and help parts of the world disproportionately impacted by climate change. What else specifically are you doing there to close the climate divide?
Well, first of all, I think it's really important to think a little bit about the problem that we and others are trying to help solve. So much of the work that is needed, especially to adapt to climate change, really involves better use of AI, more data, better predictive modeling. You look at predicting wildfires, whether you're in the United States or India or in Africa. If you look at things like responding to floods, you need to be able to predict these things and then give people early warning systems. Yet, if you look at Africa today, for every 14 data scientists that there are in developed countries,